Hey, hey, what's up, folks? Now we are going to be looking at the US30, and then I'll be showing you guys how I actually trade. And if you are guys are wondering why I always put my head in the back, well, it has a logo that I don't want to show, but it's fine. Yeah, okay. So today we're just going to look at the overview of US30, and then I'm going to be showing you guys how I actually trade and how is it different from any other traders, because I actually when I trade I actually combine two things. You can say actually three. I combine, which is some people might think it's actually complex, but it's actually not. And I think the three things that I combine is first, um, is the what do we call it? I combine first is the trend lines. I use the trend lines only. I don't trade the trend lines. I use the trend lines for daily for market biases of where the market is actually heading. Compared to others, I use trend lines to compare where the market is going. That's the first thing I use. The second thing I use is SMC, smart money concept. But I use a portion of smart money concept. Which portion of smart money concept I use? Well, I use the order blocks to determine, I use liquidity to determine where the market is likely to turn. That means trend lines do not determine, or a resistance or support do not determine where I want my trace to 10. No, it is determined by where there's a supply or demand, it is deficiency, or where there's like other blocks and stuff. What you see, yes. And uh, then that thing that I use is your ICT. Guys, ICT and smart money concept are actually two different things. Someone could argue that they are very similar, yes, but ICT's argument is that the market is not really controlled by your supply and demand. It's controlled by, you could say, sort of machines, liquidity providers, such that auto liquidity providers, such that they they know exactly where to turn, where to turn the market and where the market should go. That means it simply means it's independent of your choice of whether you want to buy at the point or who wants to buy at that point. The market will buy there if it wants to. That's the argument I know from what do we call it? From ICT. But let me just share my video feed, and then so that I can show you my analysis for the US30. This is 8 p.m. And then it's on the 6th of March 2024. So it's very recent. I'll just share it as soon as I am done. All right. Let me just share. In fact, I'll see when do I share it, because of I need to do some editing. All right. Let me just share. I'm going to share my trading screen. Share. All right, folks. Now we are at the trading screen, as you can see. This now is on the daily. This is the daily. This is the daily chart for the US thing. Is an uptrend. You don't need a ruler. You can clearly see. But for the sake of your trend line, right, guys, your trend line doesn't need to touch many lines, especially with the strategy I'm about to teach you or I'm about to show you. It just needs to indicate where the market is going, because the market does not actually turn where it touches the trend line as often as how it may seem to be like that. I can prove it easily. If you are here, it's turning. Just look at it. Touch, touch, touch. So what would you expect? You would expect the market to go up here. Did it go up? No. So this is the point that I'm trying to make. The market doesn't turn at your trend lines. Stop using them to expect a 10. No, this is not how you trade, guys. And then let's just go to 4 hours now. Trend lines only determine the direction. Please use the trend line to determine the direction, not to enter trades if you want to save your money. And then now, as you can see over here, it's another trend, right? It's an uptrend. This one was more steeper, where you have impulse correction, impulse, little bit of correction, impulse correction. This is how actually the market moves right now. You know, right? It's basic impulse correction, and then here the market consolidated a bit. So here, what it did, it actually formed another trend. You see, someone would say, yeah, well, here's, look at it. It touched, it touched, it touched, it touched. So the market, the trend thing works. Okay, if you think so, look at, I touch here, I touch, and then it comes, we're gonna come here, and then try to convince yourself that actually the trend is like this. Believe me, most of you would actually do this. And then this would make sense to turn and go up here. But what did it do? Exactly. It went down, and then it took out many people. That's because that's the aim of trend lines. They are not here to make you win, you see. So yeah, so let's so that is why hence I do not trade the trend line. I just put it to show me where are we going, you see. Exactly. And then you can also, if you want to use smart money, you can use higher high, lower high, higher high, lower high. The only problem about smart money, higher high, lower high, there will be a place whereby you will find higher high, and then a low high, and then you will find something that changes character. After changing, after the change of character, it still continues up. But you thought that actually it is now changing towards the downside. Well, it happens. And that actually is where what do we call it? ICT enters. Higher low works, but doesn't work. It's every time, like your, what do we call it? Your trend lines. Trend lines even are a bit worse than to be honest, SMC. But yeah, okay. Now, since you have this strategy, this scenario, right? You are here. Well, it turned. Someone will say it's turned because of the what we call the trend line. No, it turned because of what we call an order block. What do I mean? Let me just prove you. What is an order block? Well, first, here's the thing. Ne? The market has grabbed liquidity here. We can go to an 1 hour where you can see clearly. Here is liquidity. The market has been building liquidity too, as giving an impression to go show you. So as I have said that this is liquidity being grabbed. The stop losses that are here, they are being grabbed. They are also being grabbed around. Okay, this point is not yet grabbed. That means it respected. So here's the thing. So liquidity is grabbed at the order block. That means why is the order block? Is the last down move before the uptrend. Which one? This one. This is the uptrend. Where is the last candle that went which candle went down before it went up? Is this one here. So you can put it here or here at the wick. It's up to you. Well, sometimes it doesn't touch when it's here, sometimes it just touches at the wick, but I like to put it there, you see. And then put it there, and then boom, look at it, exactly there. It turned and then it went up. You see, this is the cause for the change. It is not your trend. It is your order block that made this thing to go up. I've researched this of many times as possible, and I can tell you right now that it is actually the fact that made it to move there. Okay, so now let's also check. So someone might enter here, right? If you enter here, that means your stop loss would be obviously below this level. It's fine. But I don't enter there. That's now I've completed 2 stages. I've completed the event. Secondly, I'm now going to, I've done the SMC. I mean, I want a part of it. which I've determined liquidity, and I have been grabbed, and I've determined the order block. Now, the third phase I'm going to take is ICT. Where is ICT? Well, ICT, well, you can see that this was going up and then it's been grabbed, right? That's also ICT. So when it goes down like this, and then it changes. So immediately when it starts changing, I do not enter. I wait for it to make a swing high. You see, a swing high. Yeah, this is a swing high. So immediately when it makes a swing high, I want the market to either, because of the market could probably turn and go back down, right? I want the market to take out that swing high that it just made. Let me just take it here. This is the swing high that it just made. I want the market to take it out, right? And then what did it happen? And then after the market taking it out, I want to see something called a fair value gap. So the market did take the swing high out, you can see. So after taking out the swing high out, did it form the fair value gap? Yeah, this is the space. This is what we call the fair value gap. It is where the market only, you can see the body, but there's no like wicks, I want in between full body. It means that there's an imbalance between supply and demand there. This is where I start confirming my trend change. You see, this I call the fair value gap, right? So where do I enter? Well, I wait for this candle, for this candle to finish, and then the next one, that's when I enter. And then I enter only when it actually is, yeah, it's like here. I enter only when the next candle comes back into the fair value gap and touches it. That's where I enter. So where do I enter? Well, you enter, let's say, a long position, right? If you enter a long position, you put it, my stop loss could be just below this previous swing high, swing low, right? Yeah, one. And then, where is my take profit? Well, my take profit will be the difference between the high and the low. So, where's the high? Well, let me put it like this, né? It's from here to here, right? As you can see, this is the highest point and then this is the lowest point. So exactly as long as the market hasn't reached the 50%, which is this one here, then I'm still on the trade. As long as it didn't reach it. But inside the 50%, I'm going to look for where there's actually an imbalance in the market. I'm not looking for where there's liquid, no, I'm looking for where there's an imbalance. Where is there an imbalance in this? It's here. This is the first imbalance that I see here. You see, this is the what you can call it. We can call it an area of what do we call it? An area of supply. Well, here as the market was supplying, and then okay, or we can say the area of demand, whereby there was a little bit of demand, and then the price was supplied, right? Call it whatever you want. Okay, and then I'll just do it like that. Can make me say this is where I want to exit my trades, right? But because of the market is the market, guys, what strategy do I use? Well, I use a certain strategy, guys, to make sure that I will never lose just in case of it turns against me. Ne? So the strategy that I use, the first take profit must be at 1,5. I want 1,5 risk to reward ratio, or the next, the previous, what do we call it? If there was a previous swing high, whether it's below, whether it's where, I want is fine. I would take my first take profit partials. That means I'm taking around less than 50% of my entries. Then I'm taking the stop loss, I'm moving it at my entry. Then I'm going to wait for the market to actually come and hit here. As you can see, guys, it didn't really hit, it just went near it. And then there's a possibility that it may turn. You know, the market is the market. No, but as long as you were safe after it hitting this thing, listen to me, guys. This thing won't turn until it takes one of the swing. If you can go back to lower time frames, this might be the swing actually where you take the first take profit, which is at around that 1,5. You see, that's the thing. So that's what I am telling you. So this is what I just wanted for me, like, to show you guys on how I actually trade. It's important that I show you now, because on the future lessons I'll just explain the directional bias that I'm taking. So yeah, um, if you're watching this video, just I hope you listened. I hope you learned something from today, and then maybe you can implement it, and then maybe it might work for you. So yeah, this where is this market going? Well, the directional bias is still up. Obviously, it's still up because of this is overall an uptrend, right? It's going to have to take out this high in order to do what it doesn't need to reach here. The market doesn't need to reach this trend line. I repeat, the market doesn't need to reach this trend line. Even if it was here, it didn't need to reach it. The market can turn anyway. Let me tell you, when after it immediately goes after this and gets rid of it, just change your bias from buying to selling. Now look for opportunities like this where liquidity is grabbed, and then it starts turning or and leaving a fair value gap, or it's an order block. But above, obviously, maybe you might not find an order block. So utilize what? Utilize a fair value gap. Above, below, utilize what? The order block, then the fair value gap. That's how I trade. So next time, hope you will do that. Now I'm just gonna end this. I just wanted to explain how I trade, so that next time when I explain my strategies, you guys won't be wondering what am I talking about. So cheers.